Happy birthday.
Okay, I'm good. Got a distinguished looking group on my laptop. What's the matter with yours?
I do too. We even have Nelson in.
Hey, what's the problem with this camera? It's got,
Nelson, earlier, Nelson had his sunglasses on, looked like ZZ Top down there.
yeah, well, you know, I always sit under the really bright lights and this helps.
You should be under the bright lights.
Yeah.
Short questioning, right?
Okay, we're ready. It is March 8th, 2022. I will call the meeting to order. The meeting of Grant County PUD Commissioners. Rich, would you like to give the safety briefing quickly?
Thank you. Yeah, in case of an emergency, depending on where it's located, our primary evacuation route would be to go out the front doors here, and we can go over to the left-hand corner of the parking lot. We can also go out the back door here, depending on that location. And we have several other options in the back corner back here if we need to get back there. So, if we have a fire, can I get a volunteer for fire extinguisher?
I can do that.
All right, Bonnie.
Yeah, I'll do it.
Okay, since you'll be here all day on your birthday. For AED, do I have someone trained and qualified and willing to grab an AED? Randy, and I can be your backup if you happen to be the one needing that.
Okay.
First aid kits back on the credenza. Mitch, can you grab the first aid kit? And what am I missing?
911.
Nelson's gonna take 911 for us. All right, along those lines, just to share, just on a safety moment, we did have an incident this morning over at the annex building. Garbage truck, clipped an electrical panel, part of the building, started a small fire. Brian Mickle out of our facilities team responded, immediately put out the fire. We got the building evacuated. Fallon and company had been over there. So again, you know, I think the PUD talent on full display again. But we'll be having to relocate, or those folks have been relocated for the day that we're working over there. But unfortunate situation, but fortunately no one was hurt. With the PUD, that doesn't appear that the garbage truck driver has suffered any injuries.
He knew he hit it though.
Oh, yeah, yeah, he knew, or they knew they hit it, yeah. Yeah. Okay.
Okay. 2021 Q4 financial forecast. Oh, we have to have roundtable. Yes, you're right. Okay, if we're for the roundtable this morning, do you have something you wanted? You look like you had something you wanted.
Yeah, just a couple quick items. We did have an outage yesterday at Jericho. I don't know if anyone's seen the photos. There was several photos floating around with two semi trucks that had hit the pole down there. I'm not sure. It's a
3 spuds.
okay. Outage started yesterday morning. I think everything was cleared up on our end by about 3:30 p.m. yesterday afternoon. We had most folks return to service by about 9:30 in the morning, including the hub, but, you know, unfortunate incident. Hopefully everyone was okay, driving those vehicles. It did not look, great. Just quick update on COVID. If I look back at case count from January, I think we're about 100 and 101, maybe 31 for February. Just give you an idea where we're at. We're at 2 for the month of March. So continuing to see positive decline with daily case counts. So much like we'd anticipated at this point. And just lastly, we'll be bringing something on the procurement side. We're going to formalize and memorialize existing procedure that we've been bringing things off normal back to the commission if we've had direct pay or exceedance of, you know, authority where and you might recall recently on some boring activities from the line crew or Chris Heinbiger. It's been several months ago, but that had come back to you all for approval for that payment. But we're just wanting to try to memorialize and proceduralize that activity, just to keep, full transparency with you all. And we have something to refer back to as we move forward. So it really won't look any different to you all at the end of the day. It'll just, I think hold us more accountable to make sure that we're bringing those activities back. That's all that I have.
Okay. Do you have anything, Nelson?
Yeah, I got some thank yous over the Burke 26 accident. And it sheared that pole off, didn't it? Picture I seen showed it pretty broken out.
Yeah, I don't know if it was sheared or if it was just leaning up against the truck when I saw the photos, but
Yeah,
yeah.
the bottom of it was frayed.
Yeah.
Pretty bad, but, got some thank yous. So kudos to the crew. And it's just interesting, and as you're talking about safety this morning, with the incident, our safety is paid off. That's, everybody's top notch when it comes to something happening, and they just jump in and take care of it. That's kind of impressive. A big thank you to all. Because we like our people to all come home healthy. That's all I have.
I got a call from, Chuck Yarborough. He's, putting an auction yard in, down by the freeway by Dotson Road, 990. And, they had an engineering drawing for, where their fiber line was gonna come in. And, there's a neighbor to the north that has been kind of a challenge for the PUD as far as him respecting our easements. And so when the fiber installer guys came out there, he confronted them to such a point that they wanted to string the fiber in another way, and Chuck for his layout there, that wasn't gonna work. So I tried to get a hold of Russ, but Russ, I think, is on vacation or.
He should still be available at this point, but Terry and he are in the middle of turnover.
So I'm trying to figure out who we should, who should call Chuck back to respond. I followed up and he said, well, nobody called him back. That was yesterday. So we need to pass it on so he gets a response. I have Chuck's phone number.
Yeah, I'll take it and make sure that we'll have Terry get in contact with him.
It'll take me a minute.
If Russ is available, he might be a better option from the historical perspective.
Yeah, thanks, Larry. Just want to make sure that we keep Terry tied in at this point,
He'll connect well with Chuck.
Okay.
I think so.
Yeah.
His official retirement was, it's the middle of this month, isn't it? Or
No, it's actually, I'm getting a little backwards. I think it's April 4th at this point, or the April 4th may be the date that he goes out and runs out his PL. We have a policy where people run out, a month's worth of PL. Actually, I think maybe May 4th is his official date.
oh,
His number is 760-3789.
760-3789.
Yes.
We'll get him in contact with him.
Okay, appreciate it. That's all I really got.
how about you, Jerry?
I had a call about fiber build out from Goodrich's. Goodrich. Mother. Anyway, Terry was here the day that I got the text and talked to Terry. She just took it. And Elliot called me that afternoon, was very pleased. He worked with Terry on something else. And they're in the middle of working on some kind of solution, but Terry did a great job.
Okay. I would think the fiber map or whatever we would be doing his area this year because he got bypassed last year.
2024.
Oh, it's.
No, I think that's next year.
next year. for him.
Remember, he came in front of the commission, we had a discussion with him.
Yeah, wasn't it 2024? We looked at this. No, we did Churchman.
Yeah.
It might be right at the end of 24 when they do work.
Anyway, they're working on something and
Okay,
Elliot was happy, which is real kudos.
But we've already been through that.
with them.
Point being made at that time is the limestone.
Now, last year he tried to get us to change our plan and everything, so to accommodate his little neighborhood there.
But his mother was one that contacted me originally. She said, contact either her or Elliot. Apparently he did not tell her because she texted me last night.
Okay,
I think we have a handle.
okay,
Yeah, I've got a couple of things. First of all, I need to make some clarification from the last meeting that I was virtually at. Sometimes when things are said through text or virtually, they get kind of misunderstood. I was kind of called to my attention that there was an issue where maybe I might have indicated that Randlin wasn't doing her job over the piece where you have authority on, where we're supposed to look at it every 2 years. And I had forgotten that we do that every 2 years, and with COVID and a lot of the other stuff that's been happening, things just kind of escaped me anyway. I'm, sharpest tool in the shed, but I said, well, I guess as long as Randlin, which she keeps the ship sort of going forward here for us and keeps us all on task, if you will, has all these things in her calendar to make sure that, we stay on track with the things that we're supposed to be doing at the given time. I said, and I had just made the comment, as long as, Randlin's bringing it forward, I'm okay with that. Not implying anything that she wasn't doing their job, but it might have been possibly misunderstood. So I guess I'm making a public apology if I was offensive in that matter, being virtual. So, and it's just kind of, for me, I guess I just wanted to kind of prompt the commission, so to speak, if we are virtually, sometimes things that are said don't come across the same way that we think we're saying them, right? So anyway, so Randy, my apologies if that came across inaccurately. There was no intent on that you weren't doing your job. It was just, I'd forgotten that happens every 2 years, and you're the taskmaster to keep it on track. So I appreciate you doing that and the things that you do for us. So, as we have discussed this morning on some things that are happening here with performance evaluations with both Mitch and Rich. So the other thing that I have, I'm not sure who to give this to, but I will state that this plaque came to the Honorable Larry Scott. Just for clarification, but it is from.
It was a misprint.
It was a performance award from the Department of Ecology, and it's for grants dedication to the Crescent Bar wastewater treatment facility. And I guess I find it appropriate at this point to pass it along to Mr. Gazelle, because I know he was there on the onset when this is all happening, and it can get passed appropriately to wherever it needs to go. So
Anyway, I thought I'd get a plaque for wastewater, but
I would say some comments from the public session.
thank you. I will, I'll actually pass this on to, Ty, Ross, and then Shannon. Probably most appropriate that it goes to Shannon.
So I think that's all I had.
that's what you have.
You made a good point though, Larry, how in-person meetings are so much better. Because we don't get paid.
Well, yeah, and then the body language is too. So,
And things ain't left, period.
Anyway, I felt that I owed that to Randy for clarification. So
Thank you, Larry.
you're welcome.
Okay, I don't have anything I don't think to bring up right at this time, so we can proceed with our financial forecast?
I do have one other thing. In light, I'm looking at John, I knew there was one other thing. Run while you can, pal. There was an article that came out that Kevin sent out this morning, which is really kind of interesting. So it's sort of limelighted the financial department, so to speak. And I think, I believe here at Grant, we have some great checks and balances in place to help things like that for county. And I guess publicly to say that, that should give the public a level of confidence of the internal auditor, the external audits that we do, the staff that we have, and, the trust that we have in them. But obviously there was trust in these folks down from Jacksonville as well that, took a utility down the road that was unbeknownst to a lot of folks. So I think there's more to unfold in that story, but.
Yeah, it's been unfolding for several years now, and actually, Jay Stowe, who's their new CEO, general manager, he's been at the LPC meetings and, the climb back out of that hole, right, to regain the trust of the folks that they get to serve. I mean, it's lasting for years or decades, for some, bad actors, right? I mean, I think that information is public, that, with bad intentions. And so, yeah, I feel great that we have the checks and balances here and the transparency and candor that we have that will keep us from ever approaching anything, like that.
Yeah, we sure hope so. And I guess I just call that out to make sure that the public's aware of it so that we're in good hands, so to speak. Right?
Yeah, I think even, just a quick comment on the procurement stuff, right? Just proceduralizing things that, we're doing anyway, right? Let's take credit for the checks and balances that we have and how we're going to operate. The more that we can do that, I think the more robust we'll have the system built. So we don't get ourselves there, even if we have a bad actor at some point in time, right?
Yeah, right. You can still have one, but there's enough.
Yeah.
Surrounding the whole pile of events, I guess, if you will. That,
yeah.
Hopefully help us catch those.
And there's always gonna be a bad. It just happens. And just so you know, Kevin was on the East Coast, that's why at 4:31 this morning. He wasn't back.
No, geez, I was gonna respond at 5:30. Maybe he just went back to sleep early.
I think they're in Ontario, aren't they? Is that where they're at? I think they're at the OPG visit. Yeah. Yeah, I guess whatever time them, that's it. Yeah.
Yeah. He did say something about going to the NRC.
Okay.
So just don't worry yourself.
I
I don't have my phone sitting by my bed, so I didn't hear.
You know, I heard that
before
thing.
you get into it.
That's right, I warm up. And warm up to this.
But I called Kevin yesterday just to see how he's doing.
I had it on full screen.
No, that's because I just took over so that I can point and click through my machine.
Oh,
And
okay.
it shows this, but I thought there was a way to turn that off, but
Of course, you know.
If I'm owning the screen, I can, but I don't know. Try Control L. Try Control L from your screen or your laptop.
Bonnie, I don't know if you want to do any setup for this morning.
Nope.
Well, this is just a routine quarterly financial report. We did delay this 2 weeks because we wanted at year end to make sure we have the most up-to-date information. Year end takes a little bit more time than quarterly because there's extra steps to close out the books. And as of the point we snapped the line, it wasn't completely closed. But this is the final report for Q4 of last year. And we'll go through 3 different departments reporting on different functions like we always do. John will be first with the FP&A department for the financial forecast, and then treasury, and then county. So with that, I think John, take it away.
awesome, thank you. So one caveat that you'll see 2 differences in 2 of the metrics, and those are timing differences of when this report, where we kind of snapped the line and said, forecast is done, we're rolling things in. and we did actually close a few days later. And those are the return on net assets and the electric system liquidity, and then I'll talk about those when we get there. So with that, let's jump in. So
Your cursor looks like a little COVID bug up there.
That
it's
is
not a
what I
COVID
was
bug,
thinking
it's
too.
it's a highlighter. It allows me to point it. So everyone should recognize, you've seen this outline before. So again, as Bonnie said, this is the standard report. You'll see we've got number 6. So we've got some inflation scenarios run that are based off of the Q4 data and what we know about 2022 forward, 2026. Those scenarios were done before the Ukraine invasion. So my expectations are that they're short on the inflationary expectations for the next few years. So first, we'll just run through all of our assumption changes. So capital plan assumptions, you'll see that 137. When I came and talked about the budget versus actuals, we had 127 million. I knew we had already, we're going to be off of that number. Again, that's a timing difference. So this has the 136.6 million. At this time, we don't have any change in the budget for 2022 or out 2023 through 2026 in terms of our capital plan. So the only difference you're going to see from what we had in Q3 is the 136.6 million there in 2021. Any questions?
Don, refresh my memory, the 137, part of that was catch-up. Isn't that right? There was stuff not done.
Part of it is the year-end accrual. That's correct. So some of it is everyone making sure they've got all the dollars allocated to 2021 that they might not actually have allocated right at December 31st. And then give them approximately 25 days in January to get all those ducks in a row and then layer it back into 2020. So net wholesale again, I'm going to concentrate on the graphs because I think it's a little bit easier to see all the movements there. In Q3, we thought we'd finish the year at an $85 million benefit for net power. And we actually finished the year with a $90 million benefit for net power. So that's a nice $5.1 million improvement over our Q3 expectations. Out the curve, you'll see that we also see a better set of results out the curve. That's largely driven off of market prices. Most of our benefit that you see is very market driven. It has to do with the excess sales that are made either on our behalf from our slice partners, or as we get farther out the curve, what's embedded in just our what we call the open position that we just have out in the future of energy. Now, you'll notice that that number seems pretty stable through 2024. And then it takes a drop, and that's both true in what we've shown for Q3 as well as what we're showing for Q4. That's driven by the fact that our expectation is that at the end of 2024, all of the util has been used, and thereafter we start reducing our ability to make market sales.
2024.
At the end of 2024, we've used the util, so 2025, you start to see that impact.
What's the maximum voltage?
Maximum use of the project on our, yes.
Which gives us more certainty than the market. No?
you do remove the market volatility. You do. That's correct.
I mean, in its simplest form. I know you probably got a much larger explanation than that, but.
There are a number of trade-offs in terms of the pricing and market versus some of the customers that are built into the retail forecast curve and what price they're paying versus what market price is. So sometimes we see some not unexpected reversals, but for the most part, you're correct, Larry. You're gonna trade off some of that volatility to get just a firm retail price.
The only difference is right now, it looks like in the future that open prices will probably stay reasonably
That's,
higher because of all the coal
that's correct.
and that random on.
Correct.
So that's the
The trade-off.
trade-off, yeah.
Here we'll look at those wholesale prices. So on the graphs, those first four entries, those are all for 2021. You see that approximately $124 price from Q3. In Q3, we expected Q4 to have a price of approximately $61 a megawatt hour. Came in at $50 a megawatt hour. So that's a bit of a drop. But $50 a megawatt hour is much above what we assumed in budget, which was approximately 34 megawatt hour. You'll also see, Larry, out the curve. Yeah, you're looking at prices that stay right in that $50 to $40 range, and that largely remains unchanged from 22 forward through 26 for both 3 months ago when we brought you the forecast and what's in this forecast. So not a lot of movement, approximately a $2 movement Q3 versus Q4 in that forecast.
That's kind of interesting that actually by 26, John, you show them falling off a little bit. Is there that much more that's going to enter into the market to offset that?
No, so one of the things we have built into the price curve is we have an assumption that in the long run, it gets back to an expected market heat rate. So we're assuming that in the price series, the underlying fundamental is that you'll be dispatching a natural gas unit will be the marginal unit supplying power to the market. And that $39 to $41 there, that's right at that marginal heat rate of that last unit to come on. So you'll see that number remains relatively stable. So you see in the front years do this, but in the back years, it tends to be pretty stable. That's also a very, very common when you look at forward curves versus price forecasts. So what you're looking at here is a forward curve. And a forward curve, you see the volatility up front because it's looking at what the needs are today, and those can change wildly. But if you're going to transact today for a forward year, that price gets to be pretty close to whatever the average expectation for the marginal thing out in the future. That's true of almost all forward prices versus a price curve, which will deviate in price over time significantly. This gets to be a kind of a textbook economist discussion pretty quickly, but that's what you would generally see is what you see here is in the near term, it jumps around maybe 3-4 years out the curve. Doesn't move very long.
Unless it's changed much, John, right? I mean, you're really just looking at on combined cycle gas turbines, if they have a heat rate of 6,900, per million BTU times the price per decatherm of gas delivered. I mean, it is really basically what it used to be.
That's it. That is the setting the market price for electricity.
So, I mean, if it's $4 delivered, $7,028 a meg. I mean, just roughly the calculation that used to be utilized.
So are they gonna go offline though? Are they part of the?
Well, I mean, they're they contribute to carbon, right? I mean, they
Yeah.
contribute to ozone depletion, based on current technology. So, yeah, I mean, that, you would think with the plans in the state of Washington, I mean, Oregon, California, at least in this area, I would anticipate us to continue moving that way unless hydrogen technology advances that quickly on gas turbines. Would be my guess. But you still have the greenhouse gas issue with the NOx, but you get rid of the carbon, right? And they are evolving the technology, but time will tell.
But you're still gonna make a lot of electricity to make the carbon. So it's kind of a catch.
It'll be interesting, yeah, to see how things evolve.
It looks to me like in about 30, it's gonna get wild. It could. There's no way to, I guess there's ways to predict that. Who knows? At some point in time, they're probably gonna have to do some of this gas. I can't believe they'd be able to shut it all.
Well, and it may just be worth it to keep it available and run it when needed and pay the carbon penalty, right? I mean, there's probably some things to think about as we, for other utilities that already have that as part of their portfolio. If you just build it, why would you get rid of it if you could possibly use it and it still be economical to be utilized?
I don't believe the EIA's annual energy outlook from 2020, they refresh every 10 years, has significant gas being ramped down in its forward years till like 2040, 2050. And that's, they look at the asset life of the plants. So a lot of gas plants are much newer than the coal plants. It's an easier argument to make to state commissions, even the ones that are more sympathetic to carbon generating electricity, to say, hey, we'd like to take these off. They're already 60 years old, versus we'd like to take this off and it's 30 years old.
And there's still new ones being built. I mean, they're being built today in the United States.
Oh, yeah.
I mean, and they're putting recip engines even in the Midwest. So, those are going to run off natural gas. So, I think some utilities are positioning themselves to, see how it plays out and have it available. And it may not be a bad strategy for them.
I worry about the level.
Yeah. Nope. Great questions.
Yeah.
Moving on to the retail forecast, in Q3, we thought we'd finish the year at $229 million for retail revenue, all customer classes. We ended the year at 232, so that's a $2.4 million favorable movement since Q3. So that's another benefit that you will see in 2021. Also note that this has the same long-term forecast from 2022 through 2026 that we layered it in as a 2022 budget. So you see the 2021 budget, that's that the blue bars and the orange bars are identical in both forecasts. So, in the forward periods, this is all based off of our most recent forecast. Interest income, all things together, this is a relatively small movement. That $3.4 million difference from what we thought in Q3 is a function of an accrual treatment. There'll be a note later in this presentation. This one's a bit more interesting. So, you've heard the FP&A and accounting folks talking about the labor split all year long. We assumed 86-14 in the budget. Where we ended 2021 was at an 87.5, 12.5 split. So we're getting less work done with our own labor on the capital side than we had expected to get. That's not That's not a judgment on good or bad. It does come with a higher price tag. But, you know, as we can see from the 136.6 billion versus our expectation of 13, we got a lot more capital work done this year. That layers into what we assume for that forward period of forecast. So that's that 8416 that we're now assuming, and that matches our budget assumption as well. All right, on to Exhibit A. So I'll get right down to the bottom line, total budgeted expenditures. So versus the budget, actuals came in 10.7 million above budget. That's approximately a $36.6 million impact on total expenditures, but with offsets of approximately $26 million, that gets you down to that $10.7 million actual versus budget for 2021. We layer it, we take out the capital, we're looking just at net income. The offsets drive significant benefits. You're looking at a $6 million benefit for sales to power purchasers. That was locked in earlier in the year. That has to do with our auction price. You've got the $20 million benefit for retail energy sales. That's where we landed at the end of the year versus where we thought we would be, the 211 versus the 232 million. Net power came in $12.6 million better than expectations. And even though we've got that very large operating expense increase of $22 million, all things being equal, it drives a $26 million in benefit to net income versus our expectations in the budget. With respect to metrics, this first one here, the electric system liquidity for our liquidity metrics. I know this comes in at 107 million, so that's a difference between actuals and what we had in this report when it struck. Days cash on hand finishes the years far above our 250 days metric. Our consolidated debt service coverage, 2.4 versus our 1.8 target, and 30 basis points above the budget expectation. We improved our debt to plant ratio by 1%. Profitability, that's where we've fallen short. We finished the year not at 3.2, we finished the year at 3.3. That'll be a change when we get to the strategic plan metrics. But 3.3 is still under our target of 4%, and the retail operating ratio, it does not meet its target of 100% either.
Hey, John, before you move forward, can you just kind of touch on the metrics? And we had talked a little bit about looking out over the forecast and the pressure that we might be seeing potentially for rates. Can you maybe just talk a little bit when we're looking at these numbers, like what's important to keep an eye out over the 5 years?
Yes, and we'll touch on that a bit more when we go through the scenarios too, because there I think you see what the scenarios as stress cases really point out for the metrics. So I think the one that if I were looking at all of them together as the canary, it would be my debt service coverage. And at 2.0 in 2026, that's fallen off 40 basis points from where we're ending the year right now. Our target of 1.8, that's actually below what most of the rating agencies would like to see us at. they'd like to see us at above that 2.0. So if I'm right at 2.0, looking at the forecast, I probably have that's where my eyes concentrate. With respect to the profitability metrics, yeah, those fall pretty significantly, and we'll look at one of the stress cases that hits it pretty hard. Those would be ones that I think of these in terms of defense versus offense. So with my profitability metrics, I'm really looking at, hey, these are the things I'd really like to do and do a good job at. Well, those should drive my profitability metrics. The debt service coverage gives me more defensive view of the world. If things got bad, what would I be able to do? And anything above 2 means, hey, I've got the ability to cover my expenses or my debt. But my return on that assets as I move out the curve continues to suffer. Means I'm all things being equal, I might need to think about rates. I might need to think about how I drive more revenue or the cost structure of the enterprise.
And we're seeing net income decline over this 5-year time frame. So there's no surprise on debt service coverage decreasing. So we're issuing debt over this time frame too. We're starting to issue debt next year and every year, likely thereafter. And when you see the consolidated return on net assets, that's really a reflection of that net income going from 79 down to 35 million in that final year. So I just want to take a pause. So as we're looking at these numbers, that you guys can kind of scan this and see what we're seeing. We start looking out over the horizon. And this will be a recurring discussion as we go through the year on looking at the out years.
So in my view, that service has always been really a measure of business's risk-bearing ability.
Yes.
I kind of boil it
Yes.
down. So when we look at these, and we're looking at over an extended period of time, like Bonnie just said, that debt service ratio is going to decline during the period of time when we're going to have to start actually wrapping up debt more than what's projected right now. We do some major expansion like an SMR or something like that. So this has to be taken into consideration now, I think, as far as the rates, kind of poke around that a little bit, because in 2026, we want to be in a position to get favorable debt terms for a major project. And we have to be in a position to do that by improving this. We don't want to be at 2.0 2026.
Yeah, and getting favorable debt terms is keeping our ratings at where they're at. We're rated AA and AA3. So like John said, that this is a suite of financial metrics that the rating agencies look at. And so when we start dipping below the 2.0 coverage, if we get downgraded, it's going to take a long time to get back up. And so we don't even want to get to that point where an agency potentially would downgrade us because yeah, it could be a difference of 100 to 200 basis points when we issue debt, depending on the rating. So keeping an eye on this and making sure that if we start to see these go to in a direction that we need to take action, that we're aware of it, combined with the sensitivities that John's going to show, the different scenarios, that's a real good indicator of what might happen that could take us off this path to a better path or a worse path.
And depending, I mean, to throw life into this a little bit, depending on what happens with Russia and Ukraine, things outside of our control could create worse issues for us along these lines.
Yeah, there could be
Because there's
some
more risk in
economic
the marketplace.
impacts, and the day we go to issue bonds, that you would see that it moves all across the board on that particular day. We see it every day because we're buying investment. So that's definitely happening right now.
So when we get down the road to whether or not we're gonna have a rate increase. It's always better to have small, consistent rate increases than a large increase because we procrastinated to do it. So I think that's part of our strategic plan, but it's a good thing to remember. So I'd rather err on the side of doing it than waiving it because we may think things will change.
You want to go through the 8%?
No, I don't.
And we effectively don't have the increase baked in other than the 0.1%.
Yeah, we've got a placeholder amount and
Right.
it's de minimis, so.
Anyway,
Well, and Tom, the other thing the commission needs to wrestle with before we can talk about rate increases. Resolution 760.
Right.
Grapple with that, and make sure they can get the goalposts.
right. I'm just bringing it up so all our wheels are turning.
Yeah, but I didn't want to lose sight of that because all of a sudden if we go, well, we're going to rate increase, then we got to grapple with resolution. Maybe it would be better to grapple with it. Well, we're not doing rate increases. Over
And in the
a
middle.
parallel path. Yeah.
But that needs to be a topic of discussion, not put off.
Correct.
Yeah, and I think that those things can coexist, right? I mean, resolution 8769, as well as looking at what could be on predictability for rate increases. I think what I'm hearing,
Yeah,
right?
you're right.
So we can
Consistency and predictability.
work on this in concert.
And there's some of those in 8769 that they actually might work themselves out because the cost is applied. There's a larger cost now to industrials, if you will, because of the cost that's being borne through transmission, substations, and switch yards and things that this county didn't need until it arrived.
We were going to meet with the group that was looking at the rate schedules and who's in the different rate schedules. Have they met yet?
Yeah, we've had two different meetings, one last fall and one just a month or so ago. But they're looking at that, giving us a discussion of who's in there. But that's more of a residential slash
Ag thing.
ag slash small commercial. Basically, whether there's some folks that are. So it's being worked on.
I don't want to hurry people, but I want to hurry through this. If that makes sense. I want to give
Savor the moment.
my partners
Time.
some time. So
Sorry.
no problem. The next two slides really just are a way to visualize what I'm going through here in terms of budget versus where we're at right now. I kind of articulated that. This difference panel here, this is where we ended the year versus the budget. And that's a nice summary there at the bottom on net income and how it drives all the performance of the metrics. I'm going to go past this so that I can get into the scenarios. So we do a series of scenarios, two of them based on high wholesale prices and one on low wholesale prices. That graph there, that shows you where we're at, and it shows the bounds, the high and the low. You'll note that there's not a lot of variation in that, and that's also typical of forward price versus price forecast. And then we do a low load growth scenario, one that is a low load isolated, one that is coupled with low wholesale price. This is based on us just saying, hey, we're going to take the load growth, we're going to cut it in half. So what if we didn't grow at approximately 5% a year, we grew at 2.5%. And then we do two water scenarios. One is just low water, year on year on year on year, probabilistically nearly impossible. So it really should be viewed as a stress case. That has a very significant impact on net power because basically volumetrically, there's nothing to sell. And then we also couple that with what we call counterparty stable, which is saying, well, what if we sliced out the entire project today at current prices and current slicing strategy? What would the difference be? And then you get a much smaller impact on net power of $5 million, basically, because we've shifted the risk off to those partners. And so here, you're going to start to see, for the most part, all those scenarios are bounded around that orange line right there. Talk about the low water case in a second. So you don't see a lot of variability, and is with respect to debt service coverage, they all continue to meet the metrics. The exception of the low water case. So that low water case, you can see that's a very dramatic impact on financials. It's offset significantly when you layer in, hey, what if we assume we can slice everything out just the way we're currently doing it, but do it for every single year.
John, can you explain that a little bit? Because I think, wouldn't we expect to see, we already have a hedge in these nearer term years, but you're seeing the volatility plummet in the current year, so.
And that's how we designed this scenario. We designed this scenario to break those two things apart, specifically so we could show the impact of just slicing. So you're right, Bonnie, they would be, if we did it exactly how the portfolio has it structured now, they'd be right on top of each other, and they'd start to deviate in 23, and then in 25 and 26, they'd be these numbers, 25 down at the 1.4, 1.3. Very similar impact for debt to plant. You'll see that low water case. It always meets our metric of 60% debt to plant ratio, but you do see it upswing on that low water case. It's a head with the slicing strategy being a very, very good hedge against that. And then for the return on net assets, you see the most dramatic impact driving by 2026 negative numbers for this metric. And the final piece we usually talk about here is our fair market value multiplier. So that 51% that's in our current debt to plant metric, that's based on book value. We go in and we look at the assets on a fair market value using the fair market value multiplier. Talk about how that's developed. If somebody wants to get into it. But if we go in and we do that calculation, our debt to plant would be 30%. That's assuming that's something like, hey, would we take bids for the project? Open market. And that's normally where we end. We'll talk about inflation. So at the time we did this report, the PPI had just come out for 2021, finishing the year at 11%. I believe January was 11.1%. So this is the inflation metric that we're faced with. CPIs come in at 7.5%, but that's not us. I know that people will want to talk about CPI. That's not our business. Our business is, we're an industrial producer. We should produce power. PPIs are appropriate measure for inflation. So we've done three scenarios here. The first one assumed, hey, we're at 11%, and by the end of the year, we're going to be down to 5%. And that comes straight out of the last Federal Reserve expectation out of the New York Fed. And that gives you an average for 2022 of 8%. Same methodology for scenario 2 and scenario 3. Drives you down to an average of 7.5%, 7% by just saying, hey, I think I might end the year at 4%. If might end the year at 4.5%. So you're seeing three views of the world there. Again, this was done before the war in Ukraine. My expectation is that you could be finishing the year at 8, 9, 10%. When I did this, set these scenarios up, West Texas crude was at about $110, is 133 yesterday.
So John, just to clarify, where do you see inflation, like what types of functions in the business is it going to hit us? So these are the overarching results, but like where would we see it come through specifically?
Fuel will be very large, transportation. So you, not only did you have supply chain problems with getting vehicles and getting parts for vehicles, now you're going to have many more problems. So you've got more disrupted supply chain, and on top of it, you've got fuel that's probably going to be above $4 for a big chunk of the year.
Long-term contracts are expected to all the commodities involved in that, everything else to increase.
Yeah, we would, anything that was fixed right now, and the last ratio that I had, Jeremy made some phone calls around the district and was trying to get a number on how much is fixed. We thought a conservative estimate would have been about 20%, could be as high as 30%, but we expect at least 70% exposure to prices this year. With that, I'll just highlight, in these scenarios, you're not meeting your metric out in 2026. And as you can see in the most aggressive scenario 1 inflation scenario, you get below that 2% in 2025. Mind you, this assumes that it goes back in 2023 to something kind of normal, 4%, and then it stays at 3%, which I would say that would be over post-war period. That would be significant. That's 4% is a number we haven't really seen outside of the 80s and 70s. 50s, 60s had very low inflation, and the 90s till very recently, it was isolated in things like the Great Recession. You can isolate it specifically to economic events, and I don't know if we can do that now. So supply chain disruptions. Get to plant, it doesn't impact it below our metrics, but you can see it rising in all three of those cases out in 2026. And return on net assets, you can see it's driving into sub 1% performance by 2026. And that really is the
Thanks, John. If you guys have any questions, let me know. Otherwise, we're going to pivot to the treasury folks that are here. And we did schedule this for an hour. Normally we have a little bit less time, so we still are good on track for that. So I think you know Angelina. Angelina is a treasury supervisor. She's been a supervisor for the past year. And then Mark, who's behind me, we wanted to bring him in so you got to see a few more faces within the treasury department. So they'll be doing the presentation together for treasury. And if you guys want to stand up there, wherever you would like, I think there's a clicker that Randy has.
I think while Andrew's looking for the clicker, people that don't know me, I started February of 2020, approximately 3 weeks before COVID. So if you saw me wandering around the building looking for anything, even my own cubicle this morning, that is why. I've been in here a couple of times since then, but it's a little bit of a maze when you haven't been here for a while.
But anyway, my background is I came here 2 years ago after 22 years at William Blair in Chicago, where I split my time between municipal finance and running portfolios for municipal customers and bank customers, both short end and more intermediate and long end, which is why I think I was a good fit for this. I've certainly enjoyed coming out here, and I think it's been a good fit for both myself and the district. Obviously enjoyed working with Bonnie and now for Ann. So why don't you go ahead, now you know who I am, why don't you go ahead and start and we'll.
Know a few of you, I've been in treasury for about 7 years now. Started out as a data analyst, worked my way up to a financial analyst, and last year became a supervisor. Love my department. I think I have the greatest team in the world, so. Okay, so this is the Q4 treasurer's quarterly report. It's going to give you a little more granular look at our investment and debt portfolios, as well as some other metrics and performance numbers. The first thing we'll dive into here is the cash and investment summary. This is showing you where the district was each quarter with our cash liquidity and investment. Are you able to see?
Yeah, you're okay.
Sorry. In the end of 2021, our cash and investments with our unrestricted funds was at 170 and our restricted was around the 289 mark. It has come back up just a little bit, but it's pretty even keel throughout the last couple of years. I haven't seen a lot of movement with that.
Can you guys hear Ange pretty well? I know the HVAC just kicked on, so I don't know if you can.
Oh,
speak
yeah,
up a little
can
bit.
Well, if you
Might
could
just be me.
speak up a little bit.
Okay, sorry.
I am getting older as of today, so.
I'll jump into this slide, that this is a little more what I do. The one thing I probably like to stress, especially given what's going on in the world today, is how conservative our investment portfolio is, both on the short end and the long end. You can see we have significantly increased our treasury and agency and even supranational portions of our portfolio, because they're all AAA. It's all the most liquid, easiest to get in and out if we would ever need liquidity. With spreads being so compressed on corporate bonds and even municipal bonds, we've just gone in favor of buying more treasuries, because you can't go wrong with that. If there's ever an opportunity, we tend to buy things and hold them till they mature, but at some future point, if there was a reason spreads widen out and we wanted to get out of treasuries and go into one of our other approved items, we certainly could do that. Given the fact that we picked up so many treasuries at a time when, let's say, a corporate bond or a municipal bond is only 10 or 15 basis points over treasuries versus the normal being closer to 50. If we look at this a year or two down the road and we have an opportunity to jump back in a spread item, we certainly have room within our targets and our policy ranges to do that. You know, we've been, if anything, the last year and a half, we've been conservative, and especially in the last 6 months, we've been much more conservative on what we're investing. And I would suggest, I don't think they show ratings on here, but our policy, different than the state of Washington, is on credit, that being municipal bonds or corporate bonds, you're allowed to buy something down even to a weak A-rated bond. Our policy dictates that we have to have at least a AA, minus, and by 2 of the 3 rating agencies. So we're much more stringent on what we buy as well. And we monitor this constantly. It's in our quarterly IOC reports, but as far as a team, this is almost a daily monitoring of everything we have and keep track of it. If there's ever an issue, we deal with it immediately. There's not a reason to, wait quarter by quarter.
That's encouraging.
Yeah, but it's, I guess with my background in doing this, again, since I came from doing investing for very conservative entities, foundations and municipalities and front-end banks, there's not any reason to stretch out. I think there'll be a lot of people that will have gotten in trouble when rates a year ago were practically zero, that people went, bought 10-year bonds at 60 basis points because they thought that was a better idea than buying 2-year bonds at 10, and they're gonna get pummeled on it. And we're always very disciplined within our policy. Our duration was 2.2 years or something 2 years ago, and it's 2.18 year now because we just stay with our program. We always have things rolling over. And that there's just not a better way to do that. You'll have a couple of years where it looks like you're not earning a lot, but you never have the big owie where all of a sudden, you have a whole bunch of 10-year bonds that are worth 60% of what they were when we just are going to avoid that. Again, this is just, you can see, this is the most interesting thing. That graph, I think you can see what happened to rates since we've been here. And the bottom line was January, was a year ago. That's January 4, 21. You can see the short end is still laying down there almost zero, but you can see the bulk of the curve in the middle. Our longer investments are generally 3 to 7 years, depending on the accounts, whether it's reserve accounts, and certainly our Krebs, we tend to be a little bit longer. As those things are rolling off, we're now able to, definitely take advantage of higher rates. The front end's a little slower to come. Originally, they were talking anywhere 4 to 7 rate hikes, depending on who you listen to, even 2 weeks ago. And I think now with the trouble in Ukraine and Russia and everywhere else, that they went from talking about 50 basis points at the meeting this month and 50 next month to 25 this month, and then we'll wait and see. That's the interesting thing about projections is no matter what, the most extreme projections seem to go completely out the window 2-3 months after it was true on the way down, and I'm pretty sure it's going to be true on the way up. That the move on the short end will certainly catch up with the long end, but the 5-year and longer, I think, has a little bit to go. But it's, even with inflation being high, probably is not at this point a runaway issue. And that's just a bunch of experience saying that.
So something that the Treasury team has focused on in the last year or two with the volatility with rates is the fact that we have some options with the short-term cash, and how to optimize our returns with that. So repo, I think, even went negative this year at one point. We had done that in the past.
And repo is the overnight repurchase agreement. So I think, Terry, you asked about that in the meeting we had the other day. So that's where we would basically reinvest overnight, and you can invest 1 day up to 5 days, typically, some time frame around that. Right. But that was the next best alternative to cash in the past.
Yeah. So drawing the bank balance down, we've been tracking the LGIP rates, which have been competitive and have exceeded repo for the last couple of years, actually.
Yeah. And exceeded short treasury bills. Along with repo rate, there was a considerable period of time last year where short treasury bills were negative. And even today, they're still, out to probably middle of March when the Fed meets, they're still at zero, and now they're 25 basis points because that's what they're assuming the rate jump will be. One thing I can say about that'll really help us as far as if we go through this is a pretty considerable chunk of our assets that we're investing, our operating funds and cash funds, they're fairly short term. They're definitely under a year. That really hurt us through 2021 because that rate was zero. I don't know if it'll get to 1% like is projected if you have 4 or 5 rate increases this year, but we're already, as much as we used LGIP the last 2 years because it was paying 10 basis points when T-bills were zero, it's now already worked its way up to, about 15 basis points, but treasury bills are between 35 and 50, depending on if we can invest. If we know we have money that needs to go out the door, let's say in 40 days instead of 10, you're already starting to get 40, 50 basis points return on that. And that's going to make a big difference as rates go up, it's going to make a big difference in our interest earnings because that $100 or $200 million we always have kind of in the short end, whether it's set asides or just holding cash for construction funds or everything. That's been a zero earner last year because it's always new money and always turning over, and that might actually end up being a significant boost for us. Back towards something normal like pre-2020 where we were earning considerably more on that money. And again, this kind of strays this out. This is what I was talking about. You see, just based on what we have almost 50%. This is 20, it's kind of short. This is 27% and 23% for cash and in 1 year paper would have been at the time. And that's, again, money that just wasn't earning much, and that's gonna slowly start helping us considerably. We're all laddered. You can see we only have 12%. That's 5 years and longer, and that's primarily the Krebs. We have a couple longer investments in some of our reserve funds where we're allowed to do it, but it really is primarily the Krebs. We've kept our duration, as I mentioned, closer to 2 years. That is going to help us as rates go up. You know, OLIs have money to roll over. The one thing I wanted to point out that does happen when rates go up, as you can see, fair market value adjustment. That's something we are not going to be able to avoid. That's mark to market. It has nothing to do with what our return was on the bonds. We bought them or invested them, whether it was 2 years or 5 years or whatnot. The one thing on here we can't control and why we differed from the budget by a couple $1 million is you can't invest or control that interest rates. You know, 2020 dropped significantly, so that was a big positive number for us. But starting from January of 21, when rates were still almost at the all-time low, have started to normalize that change in mark to market. The change in the value of your underlying securities is going to go down just because market pricing changes. And we do our best to plan for that and invest accordingly, but the actual change is just, it's out of our hands and nothing we can do anything with.
Anybody have any questions? Up to this point. So this is a look at our total consolidated outstanding external debt. We've got approximately 8.9 million in senior lien, 2.4 in electric system senior lien, and then we have a $50 million subordinate, which is a variable rate loan. So our weighted average coupon is fixed at 3.7. Weighted average life is right around the 10-year mark. Currently, our effective cost of debt for the entire portfolio, and this is including our net of interest rebates for our Krebs and our BABs, is at 3.6. Down here, these numbers are in line with what you would have seen with FP&A when they were reporting the debt, as far as what we actually see going out the door for the debt portfolio in the next 5 years.
I think the important part on that, Ange, too, is just to kind of connect the dots with the forecast, is that we do plan to issue debt in 2023, but that first year debt service likely will kick in 2024. So not a large amount of new debt service coming on. So about $3 million by the time you get to 2026 of incremental debt service for new finance capital.
Yep, and I think one of the next slides kind of shows where those debt issuances fall in the future years.
Boy, we thought we were gonna have to issue debt a couple of years ago, though, didn't we? And that our cash is able to.
Yeah, we did push it out a year.
And I know, and it, like every year by the skin of our teeth, you haven't had to.
Yeah, and if we outperform the forecast, we might be able to push it out a little bit further, but the dollar need is too great to continue. Yeah, pushing out too far.
It's gonna push us over the edge.
And part of that might be construction, correct? I mean, in 2020, obviously, construction came to a grinding halt. And that's what we see constantly in our, I don't want to call it challenge, it's too strong a word, but our daily focus on cash balances and money coming in and out. You know, construction, which was almost zero in 2020 and allowed us to actually build up some excess funds in those things, now has been almost a breakneck pace depending on the month, you know, and I'm sure that's scheduled 2021 and 22 projects, and also some catch up from 2020 things that were planned and money was set aside for it, now all of a sudden are rolling through.
So to what you were saying, Judy, we have been able to utilize junior lien bonds in the last few years to finance capital projects for PRP. That's an internal loan to ourselves, which is a win-win for the district. But as Bonnie said, in the future years, maybe a little harder to find that equity.
We've taken on some pretty big projects here.
Yep. Again, debt to net plant ratio. Same as FP&A at the 5.2. Up above here, we've got our short-term program. This was talking about the $50 million variable rate bond that we hold. At the beginning of the year, we did have, it was a different series, and we refunded it in June, so we financed it. They typically roll every 3 years. And then down here, this is just a list of the JLBs that are currently outstanding at the district. Our internal financing. This slide is giving you a look at the portfolio and some of the attributes, you know, where we have what is callable, make whole, non-callable. This was the graph that I was speaking to earlier, where this is kind of a what we're forecasting as far as needing to do internal and external debt issuance. So the external debt new would be going out to the market for bonds. External debt remarket would be potential refundings, and internal liquidity transfer would be JLBs.
And then the one thing I'll add to that is what's nice about having some issues that are callable, and which is important in our structure, is let's say we have, you know, everybody's talking about higher rates. Well, everybody was talking about higher rates when I came in, you know, February of 20, you know, the rate projected path was up. You will have at some point likely something will cause a dip in rates, and being able to have the option to go in and refinance that to especially to a shorter call economically really works well for the district. It's sometimes a little hard to do a pre-refund because if rates are low, you're having to buy securities to refund the older ones so that the savings can at least a little bit be eroded away. But when you have callable debt out there, the closer that gets to the call, if you get a dip in rates, we'll be able to jump in and refund existing debt and just flat out lower interest costs. So we did everything we could in 2020 and 21, but it's still there the next time we get a swing to do it, we tee up and ready to go. This is probably me. This is just it talks about rate estimates and what we're using for doing some of our forward projections. You can see, you know, SIFMA's obviously that's LIBOR kind of base things. This, you can see the tight range we were in all the way through 22. My guess when we have this meeting again next year, you'll see it more go lower left to upper right, and it'll just come down to how many times they are able to bump rates this year. Like I said, originally it was anywhere from 3 to 7. Now we're 1 and hold. Just listening to what the Fed said yesterday, we'll get a little more clarity when they have their meeting. I think it's the 14th, so that's coming up next week. But the wider the projections are, like they were at the next year, the less likely they are probably to happen. And my guess is during the course of this year, we'll see probably a fairly steady, somewhere 50 to 100 basis points short-term rate. And then it'll just come down. We'll have to see what happens to like I said, the 3 to 7 year range where some of our longer investments are.
And I do believe, Bonnie, SIFMA's going, or not SIFMA, LIBOR is going away, correct? It's going to.
Yeah, SIFMA's replacing LIBOR, but really those charts will probably look fairly similar because they're both offering a range of notes on roughly the same thing. That's going to be what the short-term rate is going to be based on.
Okay. This is just a overview of our rating agencies on the 2 different systems, the Priest Rapids and the electric system. Like Bonnie had mentioned, AA and AA3. This is just additional treasury reporting that kind of gives an overview of what staff is authorized to do as far as conducting payments or investments. It's a list of where we sit with our impressed accounts. And this is a list of our current brokers and banks that we transact with.
Yeah, and again, like we mentioned, this is a constant, this isn't, once a quarter or once a year we do this. It's a really a fairly constant process of making sure we're dealing with the right people.
And before you move off that slide, just to provide a compliment to both the treasury and accounting and customer service, whose Dave's not here, but a big project that they undertook this past year or two was to improve controls around customer refunds. And so after a lot of planning and execution, they were able to close this separate bank account that we had that handwritten checks had been refunded to customers. So there thousands of checks would go out, and if you think about the volume of refunds we'd have to give back to our customers. So it's all now streamlined through our standard control. So that's a huge win for the district and a lot of people that were involved, including customers. So that's really good outcome.
Any questions?
And you've left Jen for just a few minutes to go over accounting stuff.
Well, the exciting stuff.
So if you click forward,
Jennifer.
yeah, sure. Yeah, it's the next slide on there.
Okay, yeah, so I'm not gonna read you guys, the memo that came out kind of explaining everything, but basically, there's not a lot to add, I think, between Ange and John. They kind of hit the high points. But as far as the effects on the financial go the wrong way. The financial statements, our look is really this year over last year's comparison. So as far as the balance sheet goes, assets, $92 million increase, which was largely just our utility plant, which works into what John was explaining about the increased capital, what we put in place. And that would be net of depreciation. So it's the 89, it goes 89 million increase, yeah, on that. So that's net of depreciation there. So that's kind of the impacts on the balance sheet liability wise. Again, there's just kind of some shifting around on there. I'm trying to think of the big increase. So just the debt, the down payment of the debt is about half of it. And then we see the net position change that impacts that, which is more along the equity lines. Income statement, which is we see an increase in our retail, which we've talked about all year. So that is largely because of the industrial increase, but revenue there. Taxes in turn increased, so we saw a little bit of increase in expense there. And then our A&G was up as well. But really, at the end of the day, that where Mark was talking about that gain and loss on the investment piece, we see in the interest income where it really took a hit there, 16 million, almost 17 million on that. And those are just entries. It's just accounting that we have to record those that way. So it's, as we've talked, but we've been talking about that again all year. It's just kind of where we ended up at this point in time. Let's see, the other big increase there really on the expense side was the labor, where we were up on labor. And then John had mentioned the split between capital labor and O&M labor. So the capital labor ends up on the balance sheet. The O&M labor ends up on the income statement. So when we see an increase in the O&M, we would see this increase. So trying to forecast that split and get that honed in, we'll see the swings here. So we've been working with John's group to try to get that budgeted correctly, so we can get that kind of honed in. Yeah, so that's kind of the end game. These are preliminary. We didn't have the last entry on that GASB, the regulatory accounting that we talked about a couple weeks ago. So that is in the resolution for the packet for review this week. But we have looked at that entry. So the regulatory accounting will not have, the way we'll be making the entry, if approved, will not have a lot of impact on the financial statements. We'll see a regulatory liability and asset on the balance sheet, which will take it off of this income statement like we had talked about to remove that volatility.
Jennifer, you said that it's not a material change. What is the dollar impact that you'd see on the income statement, since you did run the financials already?
There is no impact on the income statement. So we saw a little bit of change in the metrics that due to just the balance sheet impact on the net change in net plan, right? So it was,
And
and liquidity.
All right. Do you guys have any questions for the finance folks?
It's quite a presentation. Thank you guys for putting this together for us. Really, I enjoyed the presentation about the investments. To really see what we're doing there.
Yeah. Yeah.
Instead, it's hard to make money today.
And they landed it right at 59 minutes, which was impressive. I was a little worried coming in toward the end. They did all the hard work on it. This is where it all landed. All right.
Okay, like I said, thank you very much. Appreciate the presentation. And, Gary,
I'm just glad all you guys are still.
You've been going through that.
I have just much.
They call it
Onboarding?
onboarding process, so you've probably looked at a lot of this stuff recently yourself.
Welcome aboard. Good to meet you.
You're welcome. Hey.
You're not getting rid of me today. I might be here all day. This one I'll stand for because I don't need to point at individual numbers as much. So strategic plan metrics. So this will be a rehash of a significant portion of what we've already gone through on the financials, but the other pieces will be interesting. So number one. Objective number one is safety performance. Our metric is our recordable incident rate, target of 0. We ended the year at 2.1. We thought this number would come in at 1.6, but when they did the final tally through the entire year, they had an incident that went into the recordable bucket rather than the not recordable bucket. So all things being equal over 2 years there, you see that trend line's downward sloping, so that's a positive impact, but we still did not meet our target, which is 0. Objective 2, we got 4 metrics here. So design and sustain an engaging and fulfilling grant PUD culture. Our first metrics, the organizational health index. This is done every 2 years. It was done just this last year. Score is 55. Our target is to be in the top quartile, so greater than or equal to 75. So we do not currently meet this target, but this is an improvement over our 2019 survey, which came in at 42. Also, you'll note the response rate. So we got a significantly better response rate by 20 percentage points over 2019. Employee engagement assessment. This is another one that's done every 2 years. We're trying to be in the top quartile. Our current score is 26, so we do not meet that metric. So our next assessment will be this coming fall.
What does that encompass, the employee engagement?
So, and maybe one of the exos would jump in. So I don't know all the details on the employee engagement, but I remember looking at the survey and me taking it. And it's how well things are getting news across the district. How do I feel in my job about engagement on activities? Do I know what's going on? That sort of thing. I don't know if there's.
Yeah, and I often get these two interchanged because there are some similarities between the OHI and employee engagement. But I know that, you know, Thomas has been deliberate about offsetting them, so we're trying to measure some these on off years. We can, you know, get some of the details for you, Larry, you know, and maybe highlight some of the key differences between the two. But I think as John has explained and with Dave out today, I don't want to say something incorrectly. But there's been a lot of work and focus here. You know, the target that we had established, I think it'll be, you know, it's going to be a stretch for us, but, you know, it'll be interesting to see where the data takes us. But we can get Thomas. I'll take that and follow it for you.
I think the important point on the employee engagement is that's from 2020. So that's, you know, a year and a half old. We do it every other year, so we'll do it again this fall. But keep in mind, we did that survey. We were in the thick of COVID,
Yeah.
right? So engagement is probably naturally going to be a little bit lower because of the pandemic.
That would be my comment, is this is
Yeah.
really a fair assessment of what we've been going through, right? So it's.
No, and that's the reason I think when we see the data come out this year, we might, you know, want to have it framed in a fashion, right? Because things are changing, right? And I think we need people back. So it may not be as big of an increase as it appears on paper, right? I think it'd just be something for us to make sure that we're continuing to focus on to keep people feeling the way that they deserve to, you know, feel, and us acting the way that we should. So. But I would be shocked if we don't see a significant improvement, just as Jeff has highlighted.
I would agree.
Next two metrics under objective two, so educational reimbursement target. This is you want to put people into the program, and then you want 75% of the people you put into the program to meet their objective, whether it's a certification or it's a degree or whatever it is, apprenticeship. So again, that's to be, hey, we want people who enter and that we pay for to actually get the end result. So since 2016, we've gotten 15 of 20 employees to exit the program with that apprenticeship certification or degree. Currently, there's 25. Historically, year on year, there's been 11 employees.
And if I can hear, you know, I did have a chance to talk to Thomas last week about this, and I think the key thing here is what we've invested in folks, and he may have shared this with you, Terry, with your onboarding, that those that have completed programs have not left the district. So I think that's important to note. It is a big investment, but to date, and I want to say Thomas maybe said over the last, you know, it was more than a decade, but I mean, to think that type of investment, no one has left the district. And, you know, total date to spend, yeah, it's a pretty big number on educational reimbursement. But if you start thinking about turnover and transition of people that utilize it and then leave and then having to bring someone back on, that can quickly dwarf in comparison to this investment that we're putting in folks. So I think that is a good note. I don't know, Terry, did he share that with you?
No.
No? Okay. Maybe he said that he shared it with someone else, but anyway, just wanted to pass that along.
Well, that's way better than I had anticipated. Yeah.
Now, there may be a little in the words there that have completed a program.
Well, yeah, but still.
Yeah. I think it is a good indicator.
Yeah.
So they're not using it for step out.
Yeah, not Grant PUD University.
Yeah.
That's right. It's getting used more and more. I mean, word's getting out that it's there and
Yeah, I mean, I think the budget that we had established for it in 2021 was actually exceeded just a bit. Which again, I think that's investing in the employees and giving them the opportunity.
Which fits right in with this last, everybody moving, reshuffling. These guys can see there's a place to go. You know, if you wanna set your goals and move forward in Grant PUD, the opportunity's there.
Yeah.
So I think it goes hand in hand.
One of the cool things that I learned in the onboarding process is that Tom and his group can sit down with the employee and map out a growth progression for them to get, if they want to sit in a certain seat, you know, they can map it out with and are willing to do that. That's real positive.
Yeah, and if you look at just from a normal transition and retirement, seeing where we may be utilizing or losing some critical skills, right? Are there folks that are out here in the wait trying to get there, and how can we, you know, manage and marry up those two plans together, right? To where we don't have the gap, and hopefully we can just, through appropriate succession planning, have people ready to go.
Our last metric is training effectiveness assessment. These are the questions that get answered right at the end of a training. So you go on to whatever the training system you're on. Right at the end, there's a series of questions, and that's so you're almost guaranteed a response, because I actually can't close the thing until I answer the questions. So our target is 4 out of 5 stars, and currently we're at 4.5 stars. So. And on to our first of our two financial objectives. Objective 3, maintain a strong financial position. First metric, electric system liquidity. That 112 number, that's the number that I showed in my report that I highlighted, actually 107. So all things being equal, not a big deviation there, but it is different than that 112. That does put us over our 105 million target, so we do meet that metric. Our second one is our consolidated return on net assets. Here, our target is 4%. That 3.2, that is 3.3%. In our final numbers, in either case, that does not meet our target of 4%. And then our third metric is our debt to plant ratio. Here, it's less than or equal to 60%. We're at 51%. Measure for 2021, our final measure for 2021 is 2.4 times, so we do meet that target. Equal to 100%, we're coming in at 115% for 2021. Peer group of excellence retail rate index. I've gotten some questions on how this works. So we've gone out and looked retail rate, not based on their schedule, because that $1 per delivered megawatt to their customers. And we do plenty of normalization of that number, and we come up with an index, and then we make sure everybody's anonymous, and then we rank ourselves against that. And right now, we're coming in at 98.1, and actually are different. They just happen to all be lined up, and I think that's a function of our normalization. But against the entire index, it's less than or equal to that 100, and at 98.1, we meet that metric. And then our final metric under AA3 Moody's Moving on to objective five, outstanding service to customers. Our first metric is our average service availability index, or our SAI. Here, that target is 99.985%, and we are short by 100,000ths of a decimal point.
John,
Yes, ma'am.
Christine sent a little message here that says your audio is cutting in and out. So maybe you stand a little closer and.
I'll stand right here.
In the side of the app,
Not even on, it's the Polycom, it's the bar right below, it's the small bar below the large bar and it's picking up the sounds.
Well, you move around a lot, turn away from it, I think it's really
I'll focus my conversation with the bar from now on.
The problem with that is when you turn your back to it, your voice doesn't project. So I've had that when I've been listening to you guys.
Okay, thank you.
So in our early in the year, we had two instances where, or in 2 quarters, we didn't meet our target, and that's what's driving our underperformance here. I'd have to defer to Mr. Gazelle if he had any more information on this. Moving on to our next metric, customer average interruption index, or CAIDI. Here we would like to be less than 110 minutes per interruption. Right now, we're at 166 minutes for 2021, so we did not meet this target this year.
But a big portion of that, and Jeff, correct me if I'm wrong, would have been that Winchester outage, right? Where we ended up having those 3 poles down out there for those days. So,
Yeah, that set us on a kind of a rough track. And we've had a number of other significant outages since then, not as big as the Winchester, but still, we had a bit of a rough 4th quarter. It hasn't been as bad so far this year since January 1st. The 4th quarter was kind of bumpy.
And our last metric for objective 5 is PRP availability. Here our target is 12 out of 12 months, meeting that availability target for 12 months at the project as a whole. You can see from the Wanapum and the Priest individual charts, there were underperformance in April at Wanapum and then May for Priest. With the offset between them, it was really only an impact on April of this year, but still, that meant we only hit 11 of 12 months.
before you move off of that, I've got to give those folks at Wanapum again another shout out. I think it was the month of July, but Wanapum had 100% availability for the entire month, which is, it never happened since I've been here. Now, of course, there's always been a unit outage, but I just think it goes to show that the work they're doing there and have done from preventative, corrective maintenance and keeping things available. Really a significant impact. Sometimes some of that stuff gets a little lost in the way we talk about this, but just wanted to pass it along that all those folks in power production, but specifically Wanapum, a banner year when it comes to unit availability.
And I think it's also worth pointing out that we've kind of steadily increased the bar, right? We've raised the bar over time. So this isn't a low bar that we're, intentionally setting in order to meet it. I mean, we've like I said, we've raised the bar. This is really, really good performance relative to where we've been previously.
Yeah, we were talking when I first got here in 2017 about 80%. We were ramping it up to 88, 90, 92, 95. So expectations are moving up, but the folks are responding really, really well.
Objective 6, operate responsibly. Here we've got 5 metrics. First one is our financial statement, audit performance. Our target is an unmodified audit opinion that we got for 2020. Next is our Washington State Audit Office compliance audit. No audit findings is our target. We had no audit findings in 2021. FERC NERC WEC compliance performance. Our target is no findings. Let's go through the asterisks for 2021. So for 2021, there are no new findings. So that's, we got no findings in 2021. Now, there are open enforcement actions. That means there are findings that are outstanding. And when they get closed is not up to us. So they may get closed in some year, 2023. We don't know. But there won't be anything for 2021. So we do meet that metric, and you'll see that do the wrap-up slide. FERC and regulatory filings, no late filings. We've had no late filings. Environmental and cultural stewardship, no issues. We've had no issues in 2021. And objective 7, develop and sustain a broadband network, a sustainable broadband network. So our first metric here is to, on the capital side, the expansion project, whatever we set out, we are going to meet that for the year. We blew past that at 108%, 118% versus 100% of the capital spend projection. Mind you, in Q3, we were only at 80% of that 100% number. So we had a very heavy Q4. And then the last metric here is our average system take rate. Our target is to be greater than or equal 67%. We've come in just underneath it at 66.9%, meaning we do not meet this target. And at the bottom here, this panel, you can see that take rate and participation by Grant County community. And then this is the wrap up, kind of has everything on it. If you just want one piece, I will highlight, because this is end of year, you see that final column that has the monthly and annual, kind of the periodic rate at which we update this. This is all just for final 2021, so it wouldn't have any of these January results in it. So we'll start doing that next one too. With that, questions?
John, one of the things that we talked about going forward too is that John is probably going to be partnering with some of the district subject matter experts on some of these metrics and have some more folks come in and talk through. John and his department does a great job of, I guess, aggregating them and speaking to them, but sometimes it's helpful to see some additional faces that are responsible behind the scenes of how the numbers come together. So looking forward to that when we get that together this year.
Hey, if Judy, maybe we could take just a small little break here that works for you. We've got Brett online and he's our last scheduled presentation for the lunch.
Okay.
I just have one comment after John did this thing. I think the challenge we might have in the safety front, as people start coming back to work, is to keep that bar there, because we haven't had a lot of people around, so to speak, to get hurt, right? So, I mean, is that a?
Well, I think yes and no, because you got to think, we still have the brunt of the kind of hands-on physical work still going on, right? At the project and both in construction and maintenance. I think we need to be diligent, right? Whether it's coming in the office or just reintroducing folks that may have not been around, but I guess, I look at it from a work output, hands-on kind of work. And I don't know that there's going to be that much of a difference, Larry. I think these folks have been doing a really good job, prior. And Jeff, I don't know if you have anything you want to add.
Well, I guess the other thing, as a reminder, if you look at our budget, particularly our labor budget, I know on the power delivery side, we worked a lot more overtime hours, which is part of the reason we blew through our labor budget. So when you consider additional hours worked, means you're at work more. There's more of a chance that you could be injured, particularly if you're working, on overtime on a Friday after you've worked a long week already, or on a weekend or at night responding to outages. So we actually worked more hours this year than we did the previous year.
Well, let me retract that and apologize a little bit. think of, when I think of returning to work, I think of folks here, right? All that work's been happening, and obviously they've been very, very diligent in what they've done, but don't want the folks that are coming back here to get complacent. Because they haven't been in the heat of it, the thick of it. It's, you know, you still have slip strips and falls and all those kind of things going into the building and, you know, falling on your chair. You know, I'm just.
Oh, yeah, no, I think it's true, right? Some of the things that haven't been utilized on a consistent basis over the last 2 years on an office setting, yeah, we need to be really vigilant about, right? And not make assumptions. But yeah, I think all those human performance characteristics that we're looking for folks, we need to be on high, you know, on high as alert as we always are.
Sure. And as some folks get engaged back out into other arenas, whether it's down to the project or the shops or whatever, you know, as everybody's been diligent, kept it down to that 2 or 2.1, right? You layer some more folks in that maybe interact with these folks, they can affect what that number does, is all I'm saying.
Oh, yeah, no, and I think, you know, the CI team work, the latest CI team on the active work zone, right? It's probably worth us going through a refresher with those coming back. Hey, be respectful of these things. These are the things to be on the lookout for. So that's the point well taken.
But a recordable injury at home is still a recordable injury. And if they're presuming that recordable occurred during work hours, it still hits our recordable incident rate, even though it may have occurred in a home office.
And before maybe we break, I did get some follow-up, Commissioner Flynn, on the jump. I did get information that Terry had gone out on site yesterday with Chad from Hydershot. Not sure when the last conversation you may have had with Mr. Yarborough was, but they did go out and talk to him and everything. They left thinking that everything was good on both ends. So just wanted to pass that along.
Thank you.
But if it's okay, we can maybe take 10 and come back for Fred at 11:30.
Take a break till 11:30.
Yes, thank you.
Looking forward to that conversation. Yeah. Well,
If you didn't want to do it in your deal, when you stimulate conversation, you have to look at it.
Okay, I'll take it that way. I'm glad I can, I don't want to stir the hornet's nest.
So Jeff, you showed up to the meeting late, so you missed out of the singing. So we're gonna have to have a solo on that.
You want to do it now?
It's recording, so we didn't record earlier.
I can see.
Yeah,
And actually, the break is recording.
and you missed the part where it was the best
You did.
birthday, so.
I apologize for missing the singing party, but I did send you the gifts this morning. Did you see that?
Yes, I did see gifts.
Gifts, the GIFs.
Oh, yes,
The
thank you.
memes. What's the difference between a meme and a gift?
Now you're gonna have to actually send her a gift.
I know, I was thinking there was like flowers on my desk. or
Gift.
something.
Gift, not gift. but
Yeah.
Gift.
Sometimes the T silence in that.
What's the difference between a GIF and a meme?
I don't know. I'm not gonna say because it's recording and I'll be proven wrong by somebody.
Well, my daughter just texted me that Russell Wilson was traded to the Broncos.
Oh, really?
Yep.
That's interesting.
Doesn't
Probably the
break
end of
my-
an era for Seattle football.
Doesn't break my heart. I liked him when he was younger, but I guess there's no I in T. That's what I think.
Not in English, anyway.
Yeah.
Maybe a different.
I was just telling you, I'm having a problem, Jokic comes back, we were having. They moved. I'm gonna jump up and down the screen.
Yeah, that's a good point.
Like I said, we've been around with him twice already.
Yeah.
Yeah, and this is bullshit. It
Yeah.
just keeps coming back. The answer is no.
Yeah, I think that's right.
This isn't muted, just so you know.
Okay, well,
Thank you.
I guess we're still being recorded then.
Yeah, and yeah, not muted.
Well, it's probably not gonna be recorded because you gotta be close to the bar up there, I guess.
No, I think they can hear us.
Oh,
Well, when you turn your back.
I'm not worried about it.
Here. I've never been that feeling guy.
For the record.
Yeah. I'm just.
Is Gina back to work? Is she still?
She's having surgery.
I think she is on her second arm.
Messaged her this morning and wished her well. She'll be out for a while, but looking forward to it.
You got any corn left to sell?
No.
Do you? Just went to $300 a ton, so it's just.
You still have some insurance for it?
Yeah.
Wow, good for you. I talked to a hay grower the other day that's not gonna buy any fertilizer this year.
Well,
He
you
said,
know,
I can't pencil it out.
yeah, hay growers can get by 1 or 2 years, but it's a catch up.
He said he needed 2 more tons to the acre to just pick the
Fertilizer.
fertilizer. He just wasn't gonna do it. He can get it.
We get a chance to talk to you after that. That's.
What's that gonna do? That diesel fuel price gonna do?
That's already up there.
That sucker's gone up $1.40 in 14 days. I contracted some fuel back when I was in Hawaii after 304, and it was kind of jumping when I did that. Morning, the price was $4.60.
Oh, goodness. How smart you were.
I gotta go the other way. I'm contracted for 271, so I'm all.
It's dialed us. It's simple.
Yeah.
Wheat prices, I had a strike price in for 950 and it was 1080 2 days ago. Just going, oh, man. But who knows, you know? You got a price for profit. We don't have a crystal ball.
Wish we did.
No,
Everybody to see.
I'm trying to get Bonnie to be some sort of.
And I got to that.
I think that might be a conflict.
Oh, would it?
I think.
Well, it depends if you want to eat or not.
I think I'm giving very good advice, but that's the risk too.
And then we say it's all bodies.
Yeah.
So that's the conflict. It would be wrong. Might be wrong.
So the senior center's okay?
The senior center's okay. Maybe over we
Yeah,
were-
I didn't want people to watch.
Yeah, me too. Me too.
Okay, I really feel bad that I.
Al,
Good.
good job.
Now you know how the problem going fell.
You see?
Hi, Brett.
On the line, huh? There
Brett.
it is. Brett.
Brenda.
Look at the picture on the line. Brett.
Didn't go over well.
Yeah.
Okay, it's 11:30.
All right, Brett.
Ready to resume our meeting? Brett, you want to get started, please?
You bet.
Tell them I appreciate it.
Apologize, I can't be there in person. Got an 8-hour strategy workshop going on today.
Took your job though.
I am at the Hob. So this is the Q4 2021 business report for Cultural Group. Just a review of the department purpose and goal. As we normally do, the Cultural Resource Department is tasked with ensuring compliance with FERC regulatory requirements related to cultural resources. These include historic and prehistoric sites and traditional cultural places important to the Wanapum, Yakima, and Colville people. A secondary goal is to help foster the relationship between the district and the Wanapum, all in alignment with Grant PUD's safety, financial, and compliance goals. Our business activities related to compliance, and in particular the archaeology group and river patrol. We were able to submit our archaeological monitoring reports on time in Q4. Also, our annual report to FERC and our stakeholders was submitted on time. And a development of the 2022 work plan for stakeholder approval was our focus in Q4. So the way that it works is we at the end of each year, we develop a work plan that helps guide us the following year, and is really helpful in sort of pulling us through our compliance activities. So with each quarterly meeting that we have with our stakeholder group, we understand exactly what the expectations are. They're clear, and we're able to meet them that way. On the traditional program side of our compliance, archaeological, historic, and traditional resources are treated equally under our guiding regulation 36 CFR set or 800. There are several active Wanapum traditional projects that are going on right now. Biggest one, of course, is the Right Bank project. The other one that we're just starting to discuss with the Wanapum is the QTEP project, sort of gearing up to understand what TCPs they might have on in the general vicinity of the different options for that project. And another project they've been involved with that's off-site is called the Lalique project. They've been working with U.S. Forest or Fish and Wildlife Service on that one down near Wallula Gap, just past the Tri-Cities. The Wanapum Heritage Center, under the traditional program on topic of collections, access, and utilization, we are preparing to reopen, and we don't have a final date agreed to or in mind. We're going to be waiting until after the Wanapum Root Feast takes place, which really consumes all the people's time this time of year. But shortly after that, we anticipate reopening. We're creating a comparative animal bone collection for our archaeology lab. It's going to be housed in the repository, but used by archaeologists. The reason for doing that is, as you might imagine, a lot of the types of materials we get off of the archaeological sites along the reservoir margins are bones, most of them animal bones, but we have some pretty stringent requirements related to human remains, and so differentiating between human and animal bones is a pretty big deal for us. And having a comparative collection really helps us know that we're not out of compliance with regard to human remains. Most of the bones we pick up are fragments. They're not nice, pristine, whole bones that are easy to tell. We are planning for new temporary exhibits. So we have a goal of creating a new temporary exhibit each quarter. And because the Heritage Center's been closed, we're just pulling those together right now. Probably begin with those in Q3 this year. Major efforts to meet ongoing goals. Wood collection for the Sweat Lodge has been happening lately. The Wanapum have a sweat lodge just behind their big lodge down there in the Indian Village, and that requires wood to keep going. Tule and hemp gathering is ongoing. That's in order to replace mats and things that they need for funerals or for other traditional activities that they do. And a canoe rehabilitation project is going to begin hopefully in late spring, but it could be late Q2, early Q3 as well. And basically, the Wanapum built their own canoe, 2 of them actually, about 20 years ago. And upkeep on those is important, or they tend to wear out a lot quicker. So they're going to be rehabilitating those. Under major projects in archaeology, on the Right Bank project, we had 4 unanticipated historic discoveries during field work there. They did result in work stoppages, however, they were quick and there were no effects to the overall schedule. So one of the things we agreed to on that project, because it's in a pretty sensitive archaeological zone, was to have archaeological monitors on site. And they happened to run into 4 separate areas where there was the old wooden irrigation line that was buried out there. And believe it or not, we had to stop work for that. We have seen some of it out there before, but we were not successful in anticipating where it was going to be located. So we ran into it digging utility lines. And the end result of that one was to get an agreement to move forward so that if we run into any new irrigation pipe out there, we will not have to stop any longer. We've recorded enough of it. Mitigation discussions for the station service replacement project are going to begin soon. The station or substations are going to be replaced down there. They have elements. What we are considering contributing elements to the National Register eligibility of the both dams, and just because they're unique in the way that they look. So because their replacement will not be able to be in kind and looking the same as they did when they were originally built, we're going to have to mitigate for that. And what that really will mean will be some sort of maybe a plaque or a new interpretation in the museum, or something that relates to their operation and how they fit into the grand scheme of things. We don't anticipate that's going to be a costly mitigation. YTC, Yakima Training Center Erosion Remediation Project is continuing. As I've reported before, we are contributing an engineer drawing for that project, but Yakima Training Center is taking on all other costs, consultation with stakeholders, and everything else related to that. So it will essentially patch up a piece of our reservoir margin without costing us hardly anything, which is always good. So each quarter I try to bring a different aspect of project cultural resources to you, and this quarter we're looking at the Beverly Bridge. The Beverly Bridge is the only historic period resource in the project boundary that's listed on the National Register of Historic Places. We have a lot of archaeological sites that are eligible for the National Register, but this is the only one that we've gone through the paperwork to actually get on the National Register. There's a major project underway to complete the Palouse to Cascade State Park Trail across the bridge, and If you drive by, you'll see that work going on right now. It's 3/4 of a mile long and 70 feet over the water. It's one of the few places where people can bike or walk across the Columbia River. A little history of the bridge. It was completed in 1909 as part of the Chicago, Milwaukee, and St. Paul Railroad. It was electrified in the 20s to run electric trains, and those ran for about 50 years and ended in 1972. Shortly after, the railroad went bankrupt and ceased operations, and the state of Washington took over the bridge for back taxes. And about a decade later, it was listed on the National Register of Historic Places. In terms of allocated resources, staffing, we do not have any staffing change. We didn't have any staffing changes Q4. And the Wanapum Safety TCP and archaeological monitors are actively working on the Right Bank project right now. Under services, we've got a language program agreement with an individual that's helping lead the language program. We do have intent to ultimately fill that position with an FTE. However, we have not been successful to date. So we're going to continue that language contract. We are gearing up for renewed RFQ for archaeological compliance. Typically, we have about 2 to 3 archaeological contractors ready to head out on our project and take care of some of our compliance needs, and their contracts are coming to a close. We like to re-up those about every 3 years on average. In terms of budget, real similar picture to the rest of the year. We're well under budget this year, and you know, COVID has been a massive factor in that. As I've reported, you know, we had to budget in anticipation of being able to complete field work and compliance projects that are required, and then ultimately just weren't able to execute fully on them. We have been able to maintain compliance, so that's positive. However, it's because more than anything, our stakeholders understand the issues related to COVID and the need to keep people safe. We are also we're riding all right, but a little bit under in some places on our labor as well. Any questions?
Brett, I have a question. A couple of years ago, when Nelson and I toured the cultural center there was a lady working cataloging a lot of items that the way it sounded to us, it was still quite a big job. There was a lot of stuff that had not been cataloged. I think she had come from Central Washington University. Was she able to work through COVID? We have to stop that whole project of cataloging.
Yeah, we have had individuals there cataloging through COVID, so that's worked out okay. Also in the archaeology labs, but you know, still take a big hit in terms of, you know, volume and not being able to have a full staff on site. Fortunately, we've got other things we can do related to cataloging that can happen off-site. There's no end to paperwork for sure.
Okay, thank you.
So Brett, you mentioned the Root Fest here a little bit earlier in the presentation. Is that coming to fruition this year, or what do you think?
It is. Yep, it will be. And we will have, real shortly, we'll have a final date and times for you. I hesitate to say what I think they're going to be right now, just because, but about a week out or so, or maybe even later in this week, we'll have a final answer for you.
Okay, thank you.
Yeah.
So Brett, you said something about the Wallula Gap below Tri-Cities. Are we responsible for that too?
No, we're not, but we do support the Wanapum getting out there and in order to perpetuate things for them, they're able to reach out and work with federal agencies to ensure that their traditional places are held together. And so we support travel and project review for Wanapum people on projects just like that. But no, we are not directly responsible for management of those places. We simply support the Wanapum.
No, that's just good for yours. What about the parking at the bridge? Did they ever figure that out?
Not that I'm aware of. I obviously that's going to be an issue. And one of the problems is there's archaeological sites all over the place down there. And, they're going to have a lot to work through on that one.
Okay, those were my questions. Thank you, Brett.
Gotcha.
Well, just before Brett leaves, I want to thank Brett for helping us navigate a challenging situation recently down with the Wanapum. I know Brett probably put in 50+ hours over a 72-hour period. So just want to thank you, Brett, for that work.
You bet. You're welcome. Thank you.
Yeah. Thank you for the report, and like I say, for the incident down there, the way it was handled. I think the whole staff of the PUD and the county police and sheriffs and after watching it, the whole chase on Facebook, I think we're all lucky, including the fellow that was causing the issue, that he had as good an outcome as he did.
Agreed. That worked out well all the way around, I think.
Okay, Brett, thanks for your report. Appreciate it.
Thanks, everybody.
Thanks, Brett.
Yeah, thanks.
I will say they'll have to work some too, the displays that they've had in the past at the center there, for people for the public to see were really, really impressive.
Yeah.
And I think that's something we should really promote. It's, like I said, that facility is not recognized or appreciated by the general public. I don't think it's nearly as much as it should be. There's just,
I think a lot of them don't even understand we have a Smithsonian class museum.
yeah, that's true. And like I said, it's just like the fish ladders that we lost, to show the kids what goes on and the fish going up the river. That's a goal we should work toward, that, more people and classes or whatever could visit that center and
Yeah.
enjoy the.
And pre-COVID, we were working on something to get all of the schools to. get
Yeah,
it
we
to
were
her
on
down
the fish ladder thing especially.
there. And
So
the hams.
anyway, for future reference, when you have nothing else to do. Thank you.
So that, concludes the reports for this morning. I didn't know if you wanted to cover anything else ahead of lunch, or if you just.
Well, everything else on there is longer time.
Unless you want to do trade association reports.
Trade association reports, we could do that real quickly. If anybody have any things from any meetings they've attended there, they need to bring forward? Not you?
Me
Okay,
and Tom kind of created a little havoc maybe in the fight or the facilities deal, but not intentionally.
Are you apologizing or what?
No, but we did have a couple of good meetings, I thought.
Yeah.
It was, no, I'm not. You apologize me?
I thought there's a glimmer of hope there.
Some and none.
So, okay, since you brought that up, Nelson, I guess I have to ask the question that I brought up a few meetings back about maybe Scott Elliott or somebody coming in to talk about their perspective, or did I miss that? Did you guys?
No, I mean, it was highlighted in the last FMP committee meeting, who all they had, reached out to, and those discussions have been pretty open and freely communicated, on preferences. If that's, what you're hinting at, Larry. I don't think there's any lack of clarity on what folks would prefer. As we evaluate options. Tom or Nelson, I don't want to speak for you,
No,
but
I think you're right on target, so.
And
So
then our,
that's coming. I mean, it's coming along, input is there. as
Yeah.
far as- Right, because my question was, I mean, I guess the way I asked my question isn't being answered. You guys feel like you're giving
I believe so. We stirred the pot a little. That makes sense. At this point, we're waiting on answers. Maybe a little change of direction.
Well, I think, the important thing was to get the consultant kind of, at least apprised of our concerns and, one of the things is, it has to meet the commission's approval at the same time. It's just not totally dollars and cents. And I thought that was probably a good discussion we had.
at the upcoming Steerco meeting, we actually have that as a topic to revisit, just making sure that all of the stakeholders' voices have been heard and if there's anything else that needs to happen. So we're gonna talk about that, this upcoming meeting, which is either this week or next. And then the facilities, the FMP is going to be, on for the next, was it the workshop or the commission meeting? So Tim, Kevin, and then the group will be back in to talk through that.
Oh,
so it's not the next work. It's not next Tuesday's workshop. It's the one after, right?
Right. It's going in for this week, the packet, so.
So it'll be commission reports, just the general commission reports. And then April.
Yeah, 3/22 commission meeting and then the April workshop.
I found it interesting. You sent us not a letter, but a report from the facilities people, the facilities department, listing and pointing out to us all of the projects that they have been working on within the district in the last, I don't remember if it's in the last year, I think. But it was a several page report.
That was the newsletter that the facilities department is doing, and that's to help keep this district employees aware of what's going on since there's so much happening. So that was the first time that they published that.
Yeah, I found that interesting.
Yeah.
They were showing us what all they were working on within the facilities department. So,
Thanks for your comment, Bonnie. I just kind of feel like I noted to Scott Elliott, he had reached out to me to make sure that piece gets followed up on. And that it's been heard.
And we can by all means bring them in. I mean, I think we've been pretty clear on, I think, the worker preference, and how that fits into the overall evaluation. But yeah, we can bring Scott in, we could bring in someone else, as well. To reemphasize, I think, what everyone already knows.
Okay. I don't need to do
Yeah.
committee work on the commission. I'm just, when somebody calls me, right, I
Yeah.
want to make sure that,
I think me and Tom knew,
I'm sorry, say that.
me and Tom knew less than anybody.
The only other, I forgot to bring it up in the roundtable, attended the virtual transmission. Can't remember.
Q-tip.
Public outreach.
Q-tip.
Yeah, from one of them up here. Okay, so as they were showing their presentations, I asked the question, and I'm gonna assume, but I don't want to assume either that it's been thought of, but as the growth happens in George, and one of the routes was to come by George, is there some, I realize it's $10 million more to come by George, but is it futuristic does it make some sense to think about the George route for what might potentially happen out there? I mean, we've rebuilt a lot of growth happening out there. Of course, the Port of Quincy's in charge of that. They're pretty progressive and aggressive. I know they bought some more land out there. So just food for thought for whoever's
So Larry, interesting you bring that up. So I went out there, I drove all over. Even scratched my pickup. That's my.
Now you're doing it.
Yeah, well, I already got my first hit, so it's all good.
What did that do to you, Nelson?
Now I put a piece of circle stuff in the back and the guy studied on some ice when I hit the brakes and the stop sign, I hit the front of the box. But, so it's internal, we don't know. But anyway, so I got with the Brown boys. And so there's a plan 4B, but they didn't have time to draw it up for the meeting, which is basically, I'm just throwing this out there because we're kind of eliminates the Badlands, comes right in there, you come about a mile and a half, and you come right up through Lake Browns, and I got approved, which is a piece of work, people don't realize it. Then go straight down Beverlyburg, straight up over the hill, right into Quincy. The single pole line, which, in my opinion, are a lot prettier than buildable. Just me. And, eliminates lots of corners, but the advantage is 28 miles, you got a road along the power line. So for the next 60 years, you can work on it. And you don't have to go up each of the lights, but, so they're looking at that. And,
Yeah, we've affectionately termed that as alternative 4 Bravo, because Nelson and Spud come in a couple Fridays ago and met with myself and Randy Kono. But
yeah.
I think, this additional information you've talked about, maybe future expandability in George or expansion, right? Does that somehow play into that alternative as well? So
Sure.
it's already something they're working on though.
Okay.
George, Spud keeps saying, yeah, when they get to the top of the hill, they just drop a line down, hook into my line. They go, yeah, that ain't part of the game, Spud. But anyway, it does give options.
Uh-huh. Just thought there.
But I listened in on the same meeting you did, and with that with it coming up to George there, they were going to actually, double the capacity of the line that runs from George north, weren't they? I mean, they were actually rebuilding that, which needs to have more capacity anyway, so they would be, use the word killing 2 birds with 1 stone, sort of, by using that. Is
We
that-
covered all those scenarios, believe me, and we did have a great meeting. It's good. And the 4th of the landowners and the 2 ground. Just some food for thought.
Yeah, and there was a potential, I think, to even cut down on the overall length, right? Which, if you just take in the rough estimates of $1 million a mile, does that impact?
Take 3 or 4 million off of it right out of the gate. And I also think there'll be some savings in eliminating some 90s or angles, because you're gonna have tie down, straight's pretty, straight's easy. I like straight.
Would that prompt another public hearing?
Well, it depends on what the engineering evaluation provides, but, yeah, I mean, if we end up coming up with another viable alternative, yeah, we would go back out and make sure that we have folks, aware and engaged as part of the discussion.
And I believe they got a lot more comments because of. So it's.
Yeah, I think we ended up having as many, in Quincy the other night as we'd had in George the week before, maybe more, from the public. So really good interaction, it seemed, and participation.
So yes, Larry, I am a pain, but,
No, I just like the way you take care of everything over there for me.
well, all my calls come from Royal City. It's the damnest thing I've ever seen.
You have to speak a certain language to get along with the Brown boys.
I don't care where the line is. I just figure it's all going to be good. We had fun too, I will tell you that.
Okay.
Well, good.
And
Thanks,
yes,
Nelson.
yes,
for
the
your-
meeting is adjourned for lunch. We will resume at 1 o'clock. You have to record it.
I think we had fun at the meeting, didn't we?
Yeah.
I don't think we had
I
anybody.
made reservations for us for lunch at the senior center.
Okay.
Yeah, you don't qualify, so you can't.